Welcome everyone, Garrett here. Today is part 7 of my series of how I mortgaged my house to buy stocks. Quick background. Built a house, did it with cash, ended up with a whole lot of value there that, I'm an investor. I like to put as much money to work as I can. So I sucked a little bit of that money out, $200,000, which represented 1/3 of my home's value, and decided I'm going to put it into the stock market and see if I can get those dividends to make that mortgage payment. Please excuse the bloodshot eyes. Yesterday I was blowing in insulation all day long, and that's what happens when cellulose gets in your eyes. But hey, another video to come. I have a 30-year fixed rate mortgage at 3.25%, and the monthly payment is $856.75. I'm buying common stock, preferred stock, as well as baby bonds. This past month, a few things did happen. One of my stocks, TPVY, was called. So I only had 20 shares of that. I bought it, cost per share $24.80, and of course they called it was $25. So teeny tiny profit there, but I was getting the dividend the whole time. Two other things happened. GEO, it cut its dividend down to 0. So I went ahead, sold those shares, and since it doesn't pay a dividend, it doesn't fit in line with this round of investing. The other one was GLPA, and it's actually one that I do like, but I went ahead and sold this one. I had 20 shares that I bought at $22.50. Of course, par value was $25, but I sold them at $27.80. So my intent is actually to shift from GLPA to GLPB because the return on them is virtually the same, but one is $1 less than what the other one is. Plus, whenever I'm looking at these, they could be perpetual preferreds, or they could have a date where it goes fixed to floating. I'm trying to keep things more fixed as time goes on, and therefore I have to kind of look through everything that I've bought so far and adjust. So those were the ones that were sold or called, but I did make some purchases as well. Not as many as I really wanted to. I didn't have a lot of time this month to do a heck of a lot of anything, so I just didn't get around to it. But I did do some. Everything purchased added up to $10,415, giving me an annual dividend of $878.84. But again, those sold calls, the total cost of them was $3,336, so subtract the two. I really only ended up buying about $7,000 worth of positions. And then, of course, I lost $377 of annual dividend in those that were called and sold. So I'm really only up another $500 annually on the dividend side this last month. As a reminder, my mortgage was $200,000, but I didn't get all of that. I got $197,460 after all of the appraisals and fees and that sort of thing. Total invested so far is $118,882, which represents 60.2% of the investable amount that I can do. $15,000 of that total invested is from Ground Floor, which is a crowdsource funding platform for real estate investors. If that's something you're interested in, there's a link in the description. So this investment gives me a $9,036.57 worth of annual dividend. My monthly mortgage, again, is $856.75, and the monthly dividend, once you divide that annual dividend by 12, comes out to $753.05, representing 87.9% of my mortgage paid for so far. I definitely need to get busy. I need to be buying more, but it's tough. This market is crazy, and there just doesn't seem to be any end in sight, which makes me fearful. Couple that with the fact that the Fed's been pumping so much money out that there's got to be rapid inflation at some point. And if you don't know what inflation is, it's basically the change of your purchasing power of your dollar year over year. So if something cost $100 last year, costs $103 this year, that's 3% inflation. If it actually goes down, that's deflation. But since there's just so much money sitting on the sidelines waiting to be invested, there's got to be some sort of inflation coming. And as I look at all of the positions that I've bought so far, including like the baby bonds and the preferreds, those are really not inflation adjusted assets. And of course, with those, I do try to have positions that have call dates out there in the relative near term so that I can get that money back in a relatively short period of time and then reinvest at that point. But if we get rapid inflation, especially double-digit inflation, I'm going backwards on this. My dividends won't necessarily keep up with inflation. And since they are preferreds or baby bonds, and I'm buying a lot of these right at par value, I'm not getting any increase in the stock price itself. Here are all of the stocks, bonds, and preferreds that I've bought so far. And like I said, I've been going heavy on the preferreds and baby bonds, but I gotta start thinking about inflation adjusted assets as well. Now, as a reminder, this is just one pool of money that I have. I have other investments out there, mobile home park, rental properties, land, all of that kind of stuff. And that's the nice thing about them is they are inflation adjusted. In my area in Kansas, appreciation keeps up with inflation or exceeds it a little bit. We are not in California where you have the huge ups and downs of everything. Everything for us is pretty darn steady. So if inflation does happen, all of those assets are basically inflation adjusted. But with these, I have to be careful. But keep in mind, I'm buying this with a mortgage, and that mortgage will not adjust over time. It's a fixed rate mortgage. And if inflation does happen, that means that the value of that mortgage, at least to the bank, actually goes down. My house value goes up, that mortgage, I pay it down, but the value of it to the bank again goes down. So while I may start this with 33% leverage in my home, it could be not that terribly long that I'm down to 25% or 20%. And that's just because of inflation. So since my payment is fixed at $856, and that's in today's dollars, 30 years from now, $856 of today's money could be more like $1,500. So again, it's relatively small and it is not inflation adjusted, which is part of the reason that I kind of like doing this. But again, those assets that I do buy, those stocks, those preferreds, those bonds, need to have some sort of inflation adjustment within them, whether it's an increase of the stock price as time goes on, or if the dividend itself is high enough year over year that it covers the inflation. Because like I said, the goal is to have this pay for my mortgage and then have a nice pot of invested assets sitting at the end of it that's worth at least $200,000. Hopefully it's worth more than that. If it's again inflation adjusted, it should be worth more than that. But regardless, as long as it's worth more than $0, this is a win because it pays for that mortgage. Thank you guys for watching. Make sure to hit that like button down below as well as subscribe. I'll see you next time.